Good afternoon. Dear listeners, welcome to Šiaulių bankas meeting with investors. I'm Emilia from Nasdaq Vilnius and I'll be moderating today's event. We will start with a presentation from the management, which will be followed by the Q&A session. Please be informed that this webinar is being recorded and will be available for a rewatch. As always, I encourage every one of you to share your questions in the Q&A box of your screen, and you can submit them either anonymously or with your name. With that said, I'm pleased to introduce today's presenters, Chief Executive Officer of the company, Vytautas Sinius, and Chief Financial Officer, Donatas Savickas. Dear guests, please, the floor is yours and good luck.
Hello, good day, everyone, dear investors. Welcome to the first quarter webinar of Šiaulių bankas. Here we traditionally will observe our results and the trends. Surely, end of the first quarter was memorable due to the global events in the banking market, mainly United States and Switzerland, and that still continues in even the second quarter. The good news is that EU market and Lithuania in particular has not faced any spillover risks coming from those areas. And also worth mentioning that systemically important banks, including Šiaulių bankas, with direct supervision of ECB, have to follow the highest requirements and thus demonstrate needed resilience to external shocks and different risks. So with that I've said, let's move on to the first quarter results presentation. So you can see on slide number 3, information of current achievement during the first quarter. So I would say strong results for the first quarter of 67% growth from 2022, and that comes mainly from core activities of the bank, working with different type of clients, and as well as with some tailwinds, I would say, supporting this growth. However, those tailwind impacts, due to our more balanced asset and liability structure and also loan to deposit ratio, which is very high, our growth rates compared to some peers in Lithuania, it's less, and that's explainable due to the more balanced our assets and liability structure. The main driver of this growth is definitely net interest income, and that result comes from, I would say, rather stable interest margins. So we maintain stable interest margins, naturally increasing Euribor, and starting to catch up cost of funding. So all those ingredients allowed us to achieve the growth that I've mentioned. Talking about loan portfolio, it demonstrates rather solid growth, not that aggressive as it was in the previous years, but that's again probably quite understandable in the current environment. During very short term of time, I would say competition in deposit markets started to be very active, and we taking one of the leading and very active positions in this growth of interest rates for deposits. So the current rate of being close to 4% for one-year deposits, starting to move clients more back to the deposit market, and clients are willingly placing deposits, the current and the new ones, with that interest already provided. Another achievement that we've been awarded by Global Finance as a best bank of the year, so it's another motivation for us to continue with our strong performance going forward. And last but not least, information about process of integration with Invel transaction of the expansion of our retail business. I would say ongoing successfully, and we have constant meetings with mutual teams of bank and NNBL colleagues, and I would say rather successful sessions of reviewing our business model, how it should run after the merger, how their organizational transformation should happen, and how the integration should benefit to the enlarged business model. So with all that, I would say that we're moving clearly to our target to complete this transaction at the end of this year. And yeah, the key ratios, as you can also see on the slides, due to the strong top line performance, the ratios also rather strong. Few comments on the provisions. So the provision level is remains also at the same as it was in the 22 first quarter, and the key impact mainly comes from revision of parameters and macroeconomic impact rather than the particular client exposures. So client exposures are maintained strongly. So let's move on to the macroeconomic situation. It's also developing rather recently with the new announcements and yesterday's news about a contraction of the economy by 3.7% on a yearly basis. Yeah, it makes a bit more concern about that figure that was most of analysts expected to be lower than that. But with that, yeah, we entered into the technical recession, and the main impact mainly comes from manufacturing, wholesale and retail trade, transport, and real estate operations. So that's are the main drivers of this GDP contraction during the first quarter. The one that maintains pretty strong is the labor market, and hopefully it will continue to maintain its strength. However, there is always the risk that it could spill over this impacts from the manufacturing sector to start weakening the labor market. But let's hope that the labor market will continue to support the economy. Annual inflation, I would say, remains still high compared to the EU. We are still in a double-digit zone, and the good news is that it is declining. Probably not at that speed that we would all expect, but the good thing is that declining, and most likely in the midst of a year it could reach a single-digit figure. So despite some negative trends we're seeing in economy, of course we need to understand why it's happening. So probably looking to the graph, we can observe that 2019 and 2020 were relatively strong to the EU comparison, when in 2019 the growth was much more than double higher than EU, and there was no actually decline of GDP growth in 2020 when it has happened in Eurozone. Therefore, this impact of those periods most likely come in 2023 with some delay, and most likely we'll see more tough time, I would say, in 23 compared to the periods in 21 and 22. So let's move on to the bank again on the loan portfolio dynamics. So we have reached almost 2.7 billion of loan portfolio, I would say, with a rather diversified composition, and we continue to diversify with the growth of the private individuals portfolio. The growth is less aggressive compared to the previous years, as already mentioned, and it's a conscious decision not to be too aggressive in this uncertain environment, and we selecting rather carefully the clients with whom to deal with and evaluating risks more carefully. Yeah, due to mainly Euribor, the yield on loans, as you can see, grew to 6%. The net interest margin also moved up to 3.9% in one quarter from 3.1%. So this increase is also essential for us. And I would say the driving of a growth of the loan portfolio is a consumer lending. As you can see, the growth during the quarter is 6%. On a yearly basis is 36%. So time to time, some of the sectors supporting the growth. And sometimes it is mortgages, and sometimes it's corporate lending. During this period of time, we see that consumer financing is more active compared to the previous periods. Okay, let's talk about corporate financing. I would say, despite the high interest rates that observed for the corporate clients as well, the pipeline, I would say, remains still pretty strong of granting new loans. So more than 200 million new loans were signed during the first quarter of this year. So I would treat in this environment that as a good growth. So the portfolio grew by 2%, and only on the yearly basis, it is 15% growth. So talking about the quality of the loan book, it's remains strong, and during the first quarter, on a yearly basis, the reduction is 19% of non-performing loans. I would say it is still very good achievement in this difficult environment that we've been able to improve the NP portfolio during the year. And with that dynamics, we've managed to reach the increase of the market share in corporate financing up to 12.5%, with increase of 20 basis points. And that is presented at the end of the year figures of 2022 as the statistics available. If we talk about the mortgages and consumer lending, so firstly on the mortgages, so the first quarter of the year, it's comparably lower to the previous quarters, and especially with a few extremes on the second and third quarter of 22. But despite that, I would say that the new agreements generated during this slowdown period, it's still rather strong. And we understand that most of the clients are willing to not make decisions as fast as it used to be in 22 and 21, when the expectations were significantly different compared to the today's market. But despite that, still, I would say market is relatively active. It presents, there's no kind of full stop in the market due to the whatever expectations of lower pricings or expecting Euribor to go down. So I would say that the needs of the client show that mortgages are needed for newly acquired flats and houses. So we expect that it will continue, definitely not on that pace that it was in 22, but without any major stops. So with that dynamic in the market and in our portfolio, we have reached 6%, almost 6% market share, with of an essential increase by 1.4 percentage points, again for the end of 2022. Consumer lending, as already mentioned, is I would say driving the growth of the last quarter. And we also expect that in the second quarter we still will maintain rather strong growth in this area. And that's a composition of a number of internal and external actions. So with the cooperation with some major players as a partners, merchants in this area. So and marketing campaigns were pretty active on that field. So we catched up quite substantial on the growth in consumer financing sector. The interest rate, as you can see, remained, I would say, rather flat at 9.3 in the fourth quarter, with slight increase in the first quarter. And I would expect that interest could start to go a bit higher to offer consumer lending, since the pressure from growing funding costs will definitely move up interest rates for this borrowing instrument. And yeah, with that, we've reached 12.3 market share in the end of 22, again with some nice increase in this business sector. Daily banking, it's more complex and more dynamic sector from different service lines. So rather moderate growth of 1, but we need to drill deeper and to understand the dynamics in those daily banking commission incomes. So probably worth mentioning the cash operations, very strong first quarter of 22, with the definitely impact of the war in Ukraine that has started during that quarter, had positive impact to the cash transactions and related income to that. Therefore, the base to compare with this year's operations is making the decline by 9% of cash operation income. The payment service is also small detraction by 1%. So mainly driven by the stop of providing payments in and out to Russia and Belarus, and also providing free of charge payments to Ukraine. So those decisions has made additional impact negatively to the payment service commissions. But definitely that's our principal position to support Ukraine in that field, and to restrict businesses to Russia and Belarus by not providing services with those counterparties. On a positive side, there are also good moves on account administration side and also on the credit cards. So the growth in account administration, which is mainly driven by the service plans, by the purely daily activity income for retail clients, so 39%. The major part, about 20%, comes with a natural growth, and 10% mainly comes from the recalculation or reviewing the accounting standards for the clients that have not sufficient cash in the accounts, and when there is a debt, it has been recognized. Currently, it is recognized as income. Therefore, this 10% increase is related due to this change in accounting principles. But the other part of 20% comes from the natural growth. And also, we are glad about the 30% growth in the credit cards growth on a yearly basis. So that's also important for our retail business development. And also renovation-related income, which is named as administration of loans of third parties, demonstrate 8% growth. And we expect that growth will continue due to the conversion of our modernization programs, which became more commission income driven than interest income driven. So with that I have said, I would pass the word to Donatas to continue with the funding and liquidity. Okay, thank you.
Good afternoon, dear investors. As I already mentioned in previous webinars, funding becomes a hot topic, and we live in very dynamic environment regarding interest rate. Competition regarding funding, especially term deposits, intensifies among key players, and Šiaulių bankas keep policy to offer adequate and attractive interest rate to our depositors. And since the beginning of 2023, we adjusted interest rate for term deposits already 4 times. Actually, these steps does not show big impact on the first quarter portfolio, but when we see what happening in second quarter, in the first months of second quarter, we see the results. But as we here today to discuss first quarter results, we should mention that term deposits increased by 50 million euros. It was outweighed by a small decrease in demand deposits, and total deposit portfolio was increased by only 1%. But as I mentioned, the trend forward, we see results, and this portfolio meets our planned figures so far. Liquidity profile remains strong, and we want to keep our LCR ratio in the range of about 200%. As per end of March, LCR ratio stood at 270%, but it was one of item and fluctuated from our main trend line. Talking about structure, funding structure, and what we expect in the coming quarters of this year, we could say that term and demand deposits will remain the main source of funding, whereas loan from ECB, which currently represent 15%, will shrink as we repay tranches according to schedule. And other liabilities, what Vytautas already mentioned, namely 2 bond issues that we are planning to issue this year, will increase other liabilities portion, this pie chart. Yes, we can move on to the next slide. And talking about operating expenses, we see growth in both main part of operating expenses, namely salaries and remaining other expenses. And the main driver for salary increase was due to the growing headcount, especially in supporting functions such as risk management, compliance, and also regular annual salary review for all bank employees. Talking about other operating expenses trends, so increase was substantial compared to the first quarter of last year. But when we look drill deeper, main changes were in IT expenses, which we invest and we have to invest significant amounts due to developing systems and necessity to provide adequate and safe framework of stable functioning of the bank. And besides IT, we could mention premises maintenance expenses increased compared to the first quarter of last year due to the energy price changes. Other items were more or less stable, with, of course, upward trend. It should be mentioned that despite the growing expenses, we keep a very good cost-to-income ratio at the level of below 40%. We can move on to the next slide. And talking about capital, it should be mentioned that despite the fact that targeted minimal capital adequacy ratio level keeps going up, in this slide we see the yellow line in the right side graph. Despite the fact that this line goes up, and this is pushed by regulatory requirements mainly, we keep capital position at a safe zone. And profit that we generate during first quarter, and we are sure that next quarters will be also profitable, provide a safe cushion and reserve for future capital growth that will allow to keep regulatory requirements, also to keep promises to shareholders in terms of dividend policy. Non-performing loans, we see small changes upward, but it does not signal any significant deterioration of quality of loan portfolio, at least so far, and no particular borrowers show signals of problems. But despite there are no signals for worsening of quality of exposures, according to IFRS requirements, we making proactive steps and reviewing parameters of individual exposures and macroeconomic forecasts, and therefore in the first quarter of this year we made additional provisions of 2.8 million euros. We hope that this caution will be sufficient in case this scenario will turns into worsening situation, and these signals of macro parameters that we heard yesterday turns into real situation deterioration in the economy of Lithuania. Yes, we can move on. And changes in share price movement reflects and reacts to external factors rather than performance of Šiaulių bankas. And namely, this crisis in some banks in the United States, in Switzerland. So we treat it as a reaction to these external factors that affect share price of Šiaulių bankas as well. Talking about ratio of price to book value or price to earnings, these both shows that, and when we look back on the history of these ratios, we see that despite good performance, these ratios show that the share price is undervalued. And with such statement, share price analysts from different institutions agree with that statement when we see to the share price target, which is significantly above current share price. That's probably all comment. I want to leave enough time for questions that we see we have quite a few.
Thank you very much for the presentation. And indeed, let's proceed with the Q&A session. And before that, I would like to remind all the attendees that you can send in your questions in the Q&A box of your screen, and I will read them out. So let's begin with the Q&A part then. And the first question would be as following. The bank has received many questions on potential Lithuanian government windfall tax. What is bank's opinion about it, and what potential impact it could have on the bank? I ask management to please comment on this topic.
Yeah, thank you for the question. It's really an actual question for today and for the nearest weeks, while that's in the discussions in different formats. So firstly, I would say that I purely understand the needs of the government, to finance public needs and interests. But the way such taxation is implemented or proposed to be implemented, it makes for me deep concerns over the maintaining countries' attractiveness for foreign direct investments and different type of corporations and partnerships. And we, as the publicly listed company with international investors, also very much care about this environment of a country to be attractive for different capital flows to the country. But in case such law is passed, we're trying to evaluate how it could influence Šiaulių bankas. So definitely it's very early stage of evaluations, since the formula is complex and not all the components are fully clear. But our initial figures that comes out from the assumptions that we are calculating is stands in the range of up to 10 million euros. In our case, however, as I mentioned, there's a number of scenarios. In some scenarios, it could be also zero. So it will depend how the formulas will be interpreted, how the market will develop with the Euribor development, with the cost of funding, with the new loan origination. So all those parameters will influence, but in our case, I would see this potential tax could be rather marginal. And of course, if we would be very successful with the profit generation, that it could be, as I mentioned, on a higher side. If it will be with some negative trends towards this sphere, that could be even close to zero.
Thank you very much. Could you please give a comment on yesterday's announcement to issue 2 bonds issues in 2023, and what are the reasons for these planned transactions?
Okay, thank you for the question as well. Yeah, those 2 issues are considered to be made this year, and the purpose of issuing subordinated bonds is to achieve an efficient capital structure, so increasing the Tier 2 capital. And that would help also to fulfill the MREL, subordinate MREL requirements set by the supervisory authority of a bank, and also to maintain the continuity of a dividend policy as the banks continues to grow. So that's mainly related to subordinated bonds issue. And the second issue, which is also planned this year, it's a continuous process that we announced few years ago, and continue to work on this program. So that's also related to build sufficient MREL eligible liabilities. And so we are targeting to increase current outstanding bond issue with maturity date in 2025.
Thank you. Could you please quantify the additional required capital due to the introduction of the sectoral 2% requirement on the mortgage loans?
Okay, I take this. As this additional buffer depends on the actual mortgage portfolio, it's not stable, and as the portfolio grow, this buffer increases as well. Currently, this buffer equals to 0.2% of risk-weighted assets of Šiaulių bankas. So it's not significant, but obviously we should take into account it as well.
Right, thank you very much. Is it correct understanding that you target 2% buffer on top of the total capital requirement, including P2G?
Yes, that's right. To be precise, our targeted capital adequacy ratio is 2.1% above current regulatory expectation. But it should be mentioned that with capital instruments, we also covering other regulatory requirements, such as MREL ratios. And as soon as we have, as the year goes by, we see the possibility to change these capital instruments into other MREL eligible instruments, and therefore the management buffer could be decreased somehow, but not significantly, but it could be below 2%.
Thank you. According to Financial Reports Note 5, bank has 629 million euros of TLTRO borrowings with repayment date on 25th September 2024. The deadline is not far away. What is the plan with this debt? Is it to refinance, and with what type of instrument? And could you please comment on the estimated potential cost of the new debt?
Okay, thank you. I will take that as well. So this total amount of 629 million euros consists of two tranches, and first of this tranche is due in the end of June this year, and the second tranche is due as you mentioned in your question. So when we borrow these funds, we also created adequate security portfolio with very similar maturity gap match, and therefore both repayments will not require additional borrowing and or refinancing. So we had maturing securities, and with these inflows will cover the ECB TLTRO borrowings. That's it.
Thank you very much. Before we continue, I would like to remind all attendees that you can send in your questions too in the Q&A box of your screen, and we will discuss them here in the Q&A session. And the next question is quite detailed, so please listen carefully. So Silicon Valley Bank example showed threats related to long-term fixed bonds in banking book. Šiaulių bankas has approximately 1 billion euros of different securities in assets, including government bonds, corporate bonds, and equity securities. Biggest share in government bonds. I suppose most of these are fixed income bonds. In raising interest environment, fixed income bonds lose their market value. You reflect most of this portfolio at amortized cost. What is the reason why you reflect this part at amortized cost? I'm sure you have internally made calculations. How big would be the impact if you would reevaluate them into market value? What would be the size of this impact? Thank you.
Very long questions, but I think that several parts could be touched by answering this. First of all, the reason why we have approximately 1 billion euros portfolio that as amortized cost. We keep this portfolio in order to have a buffer in case of liquidity crisis. And we created carefully, trying to have it not sensitive to external shocks significantly and very liquid. And therefore, these bonds are main purpose of their existence. And also, we, of course, we reevaluate them for our internal purposes, what would be the real market value of this portfolio in case we have to sell it at the stress scenario. So, and the difference between carrying value and the fair value of investment securities that are accounted at amortized cost as per end of first quarter was about 4% of their balance value. That means about 40 million euros loss. So it's a significant amount, but we are not going to sell them at the nearest future. And the maturity of this portfolio is rather short, and we'll have wait until the maturity of them that will come in the next 1.5 years. And yeah, that's significant amount, but not comparable to the bank you mentioned that face big problems in the United States, because the size of this portfolio and this loss not shown in profit loss account was not comparable to what we have in Šiaulių bankas.
Thank you very much for your answer. Let's proceed with the next question. So, deposit portfolio growth Q2Q stagnates. How successful since the end of March have been your efforts to attract deposits by rapidly increasing rates? What pace on increased and level of deposit rates you see as sustainable for the bank? Thank you.
Again, that's probably mine. I think I mentioned during my main part of presentation that we are successful when we start to change our interest rate for deposits and trying to be on top of the list of the banks offering the most attractive interest rate. And we see results in March already, in March and April, and we are in the line of what we want to be in the current time of the year. As of today, we think that this intensive increase of deposit rates are stabilizes right now, and we do not expect very big changes upwards in the nearest future. Therefore, it keeps probably this situation will have some negative impact to our net interest income, but we still have room for increase in net interest income in loan part, because not all loans were repriced as Euribor increases, but some of them still have the lower Euribor rates. Therefore, we will have negative impact on deposit from deposits on interest expenses, but will also have some positive impact to interest income from loans. That's all from me.
Thank you very much. Another attendee is congratulating you on solid results and asks you, could you please elaborate on lending in Q2, and is it slowing further down versus Q1, or maybe you see some recovery? Thank you.
Yes, thank you for the question. So partially I've answered this question by presenting the development on the loan book, but just to emphasize that overall, I would say the second quarter could be rather similar to the first quarter development. So the corporate portfolio should continue to grow, but not that aggressively as it used to be several years ago. And our, as I mentioned, conscious decision to be more selective on the counterparties that are able to sustain this high interest rate period and to sustain the businesses, as we see that the macroeconomic situation is deteriorating, and more challenges would be for businesses. Therefore, we would be more selective on the new clients, and we'll do our best to support the current clients in this period of time, since we need partnerships, strong partnerships with the clients to be in tougher times as well. For the mortgages, I would say my guesstimate will be that this current period will be rather similar as the first quarter. So those that are needed new houses and homes and apartments, they will make decisions to acquire, unless the stronger negative impact happens to the labor market. Then this trend could be more radically impacted negatively. But since the labor market continues to be strong and growth of salaries increases is expected, therefore in the nearest future I don't see major negative impacts to the mortgage lending. With consumer financing, I would say that second quarter in our case would be another growth quarter. At least we see that from the April that we're achieving good results in growing portfolio more aggressively than 3 quarters ago. Probably also worth mentioning about renovation portfolio that it transforms to the less on balance portfolio. So as you remember, we have a modernization platform and we attracted external fundings to finance renovation, so it goes very smoothly, and the interest in the market continues to be strong to renovate the dwellings to the new quality, and potentially the portfolio could start to decrease due to the financing from this new platform, and those loans will be not on our balance sheet, and the income will be more reflected on commission income side rather than net interest income. Therefore, the reduction of renovation portfolio, amortization of the current renovation portfolio could also impact negatively the total amount of loan. But hopefully we will compensate that with new loans for corporate mortgage and consumer clients.
Thank you very much for your answer. Let's continue. So net interest income reached an all-time high in Q1. Would it be right to expect net interest income to come down in Q2 as lending growth slows and deposit rates starts to bite? Thank you.
I touched a little bit this topic answering the previous question, that my view that net interest income in Q2 will stabilize as biting deposit rates, as the question mentioned, will be outweighed by positive impact from still growing loan portfolio, which are still repricing to higher Euribor rate. But yes, this peak probably is reached right now, and the coming quarters will be not such big growth. It will be rather stable phase in the coming quarters.
All right, thank you. Could you please disclose the duration of HTM securities portfolio?
HTM portfolio securities is 1.8 years. So that's it.
Mm-hmm. Thank you very much. Let's continue. What are the reasons for the lowest increase in loan interest profits among all the competitor banks in Lithuania? Why is this effect of Euribor increase for banks so low? Thank you.
Okay. I tried to explain that at the beginning, at least give a sense of the reasons, but I can elaborate a bit more on that. So Šiaulių bankas, I would say, is a bit more balanced on the assets and liability sides compared to the other peers in the country. And those peers in the country historically used to have larger deposit base compared to their loan book. And for some period of time, they were, in other words, punished by the ECB with the negative interest rates. And profits were lower relatively due to that factor. But when the trend has changed and the base rate increased up to 3%, then they started to benefit significantly more due to that change, even partly holding the funds in the ECB and receiving income from relatively large part of the assets held in the central bank. So in our case, is much more of the liabilities employed into our loan book, and therefore this effect is significantly lower compared to the peers. And historically, our profits were larger relatively compared to the other banks due to that less negative impact with the negative interest rate that was experienced by the other banks in a larger extent. So that would be the answer.
Thank you very much. So we have 2 questions remaining, and in case you have another question you would like to be asked, please write it down and send it to us. And the next question would be as following. The investors did not receive dividends for financial year 2021 last year due to the macroeconomic situation. Why did the dividend amount paid this year not include the dividend for the year 2021? And do you plan to pay them out in the future? Thank you.
I'll take this question. It's a favorite topic in our webinars. And I could repeat myself what I mentioned on earlier occasions, that each year, in the beginning of each year, the management board had to suggest draft resolution for shareholders meeting, and each year we take into account all factors that includes regulatory environment and new level of capital which need to be maintained at the bank. It also includes the growth of previous years, which requires capital as well. And it also includes the forecast for future growth and future expected regulatory requirements. And therefore, when we suggested this year amount for dividends, combination of all these factors did not allow to pay more than what is promised in our dividend policy. I mean, 25% of profit from the previous year. And the fact that this amount that remained from so-called unpaid dividends from 2021 was used to support the growth of the bank in 2022. As you may remember, that loan portfolio in last year grew by 25%. And this growth without support of capital, it's not possible. And we believe that the yield from this loan portfolio will give more and longer duration positive impact to investors rather than the one-off payment of dividends. Because without capital, the growth of bank is not possible. And remaining the last part of the questions, do we plan to pay them out in the future? So, as I mentioned in the beginning, each year we see the possibilities and what is the requirement for capital. And if we see that we have extra capital that we don't see useful usage of it in the nearest future, of course, will be shared with the investors in form of dividends or buybacks. It's also an option.
Thank you for your answer. And it seems that we have the last question for today, which is as following. What are the risks that same scenario happens to Šiaulių bankas as it happened to US banks?
Yeah, maybe just before answering this question, just to give a clear message, also what Donatas answered regarding dividends. So just comment from my side that this is the clear promise from our side about the dividend payment, and we stick to the dividend policy and in all circumstances try to follow as much as possible that. But as Donatas explained, there's a requirement dynamics that happens, but overall our current and the future actions, as much as our efforts and powers, will do all what's in our hands to maintain and to fulfill the obligations or promises from the dividend policy. So that's also showing our tier 2 capital bond issues expected. So we use different type of instruments to optimize our capital base and to fulfill the promises towards the dividend policy. And coming to the question, which is related to what are the risks that that same scenario happens to Šiaulių bankas as it happened to USA banks. So I would say that the risks for a particular scenario to Šiaulių bankas, I would say rather small, but because the scenarios mainly are different for the different banks. But saying a bit seriously to this question, I would say pretty different regulation. It's not substantially different, but there is a difference in EU compared to United States. And even for the systemically important banks, such as Šiaulių bankas in Lithuanian market is recognized. The requirements are much more restrictive than for those banks that has failed in the United States, despite that they were much times higher, bigger than Šiaulių bankas. So that's one of the reasons why this risk is more managed or more decreased. The second thing is that our business model is a bit more based on a traditional banking business, compared especially with SVB Bank in the US. And I would say the way we deal with asset and liabilities management is also more conservative compared to the banks in the United States that have made decisions to be much more aggressive investing depositors' money to the assets. So I would say those at least two elements that ad hoc I can name, probably thinking more we can provide more information or observations on that, but those two, I would say regulation and fulfilling top-notch standards raised by ECB for systemically important banks. And second, that more traditional way of approaching banking and more conservative management of assets and liabilities, reducing that risk.
Thank you very much. As all the questions are answered, on behalf of Šiaulių bankas, thank you all for joining us today. The recording, as always, will be available for a rewatch and will be sent out to you via email. Dear management, thank you very much for this session and the Q&A part. Have a good evening, everyone, and goodbye.
Thank you. Goodbye.